Hey, this is Annie Dickerson with Goodegg Investments. Ready to talk real estate? Let's get cracking. Today, I wanted to talk about whole life insurance. No, before you click away, let's talk about whole life insurance, what it really is, and how you can use it as a vehicle for building wealth. Now, I know that there's a lot of things flying out there about what whole life insurance is and what it isn't. And it may be a topic that you've just said, you know what, it's too complicated. I don't want to deal with that, or it's not for me. But I really want you to approach this with an open mind and really try to understand what it's all about. Because I'll tell you right now, the wealthy have been using whole life insurance to build wealth and to shelter their wealth for generations. So they must be on to something. And so today I've invited my good friend Lesley Batson of Rebel Rock Wealth. She's an expert at whole life insurance, among other things. And she really advises her clients, and she does it herself, to use whole life insurance as a way to protect your wealth against taxes, against creditors, and to really grow your wealth over time. And in this conversation with Lesley, we are going to talk about exactly that. Lesley, thank you so much for joining us.
Thank you so much for having me. I appreciate it.
Awesome. Well, Lesley is super passionate about helping people build wealth, and she does that through a number of different ways. But today I pulled her in because I really wanted to pick her brain about a strategy that very few people know about, which is using whole life insurance, but not just getting whole life insurance, but really using whole life insurance to amp up your investments. So we'll dive into that. But Lesley, first, tell me about why you're even interested in whole life insurance. Like, what makes you passionate about insurance? It seems like a topic that most people would run away from.
They do. They either run away or they just despise it. They don't want to talk about it. But I will say the reason that I'm most passionate about it, honestly, is because when I learned about it, I was angry that I didn't know about it sooner. I think there's a lot of bad misinformation out there. So a lot of people misunderstand the advantages of it. I think they only think of it for the purposes of a death benefit, so that when you pass away, that's when it comes into effect. And so nobody wants to think about their death. But death is inevitable. It's going to happen. Having whole life insurance is, a great tool to have, but really there's so many advantages to it while you're alive. And I think that's the part that most people don't understand and don't know about. And I just like to share that. I like to educate them on all the benefits of using whole life insurance while you're alive.
Yes, that's something you're right. So few people think about or even want to talk about, because
Yeah.
it's whole life insurance is about death. And
Yes.
so I love that you're talking about how it benefits you while you're alive. So tell us more about that.
Sure. Well, okay. And I have a little slide here. I'll share my screen.
Awesome.
Because I think it helps to walk through some of this. If anyone wants to get much more detailed information, I'm happy to do that. So this is just a few slides that I have. This is a much longer deck, and again, we can discuss it in more detail later. But one thing I like to clarify for people is that insurance is more of a savings vehicle than an investment vehicle. And I know that there are investment products, like insurance products, where they do invest, like universal life and variable universal life and index universal life. But I don't recommend those products, and we're not going to talk about those products. We're going to just talk about whole life insurance, which is just the traditional type of insurance that's been around since the Roman days, since before BC. Okay. It's the product that's tried and true, and it's been working for centuries and will always continue to work because of the nature of the product. But basically what it is where you want to, let me skip ahead here. It's about putting money away for when life happens, right? So when you want to be able to have safe money that you can access, it's risk-free and it's growing for car purchases or investments or building a business, You want to tap into your savings. When you are looking to grow that money, you want to work with Goodegg in real estate investments or in stock market or other places where you're willing to take on some level of risk for the exchange of growth. Okay, so savings is just really where you want to have no risk and you just want a pool of money to grow. Investments is where you're willing to take on some additional risk for the growth of that money.
I
Okay.
love that. The life happens account.
Yeah, that's kind of what I call it because it can be good and bad, right? It could be,
That's right. Mm-hmm.
purchasing a car, but it could also be car repairs, right?
Mm-hmm.
A lot of
Right.
people have very much, unfortunately, unplanned events. So maybe you've always planned to have a child, and there's a huge cost to having that. But maybe you were having trouble, and you had to, pay for the cost of IVF or maybe adoption. So it's all the things that can happen that are not planned is really why you want to, as well as what's planned. But for the things that are not planned is why you want to be able to have money that's accessible, right? That's available and liquid.
Let me pause there for a second, because I think a lot of people will listen to this and say, accessible? What do you mean? When I put money into a whole life insurance policy, doesn't that just disappear? How do I access that?
No, it actually doesn't at all. So we'll get to that in a couple slides. Actually, this is just a quick little table that I have where it's just talking about different places where people, choose to store their money. And most of us will have a savings account or a money market account, maybe even a CD or in different qualified accounts. A qualified account means that it's an account that the IRS has put some provisions around. So you've made a deal with the IRS and said, I will put my money in this type of account for some type of benefit. In most cases, people, are looking to defer their taxes. And the IRS says, okay, sure, we'll let you defer your taxes if you put it in this type of account. But there are some rules. And so that's what, this column is really talking about. And then this column, as you can see, all the boxes are checked for whole life insurance. And so the main difference, I would say, with your basic savings or money market or CD type of account is that your money is liquid. A CD is not really, your money's not really accessible, but you have a guaranteed interest rate, like your savings account, you're going to get 1% or whatever that is, and it's available to you. If you have a qualified account, again, if it's with your job or something like that, you're not going to necessarily have any control over, where you're investing. At least you can only choose from what accounts they give you or what funds they give you to choose from. And your money's not necessarily accessible. It's kind of locked away there until you're 65 or 59 and a half. But, if it's invested in certain things, then yes, you do have an opportunity to earn a dividend. And a Roth can grow tax-free. An HSA or 529, if those are used for the right purposes, so if you follow the rules, then you can use those monies tax-free. But everything else, the taxes are just deferred. You will have to pay them later. And what most people don't realize is you're actually going to end up paying more taxes later on that money because that money has grown from the point today when you put it in there till 10, 20, 30, 40 years down the road. It has now grown from, say 10,000 to, 40,000, let's just say, or maybe it's grown to 25,000. So now you're going to pay taxes on the 25,000 when you could have paid taxes on the 10,000, but that's a whole separate discussion. But in any case, so with whole life, it checks all the boxes. You have full liquidity, access and control, and the opportunity to earn dividends. And most importantly to me is that privacy from the IRS, right? They don't have any access or, it's totally hands off to the government. Okay. But one of the things, or some of the things that people don't understand about whole life is that it's really more than, like I mentioned, it's something you can use while you're alive. It's more than just offering your heirs a death benefit. You can store up your money in what we call the cash value account. So this is what you just touched on, Annie, is in a whole life policy, especially one that is set up properly and one that is set up with a mutual life insurance company versus a stockholder insurance company. You're number one, you are going to have a guaranteed rate of return, just like a savings account or CD. There is a guaranteed interest rate that you are going to earn. It's going to compound year after year. But you also have the opportunity to earn dividends. And the reason that I always promote a mutual life insurance company over a stockholder company is because typically your dividends are going to be higher, because just like any company, they're going to pay their shareholders first. And then what's left over is what they will share with the policyholders. Whereas with a mutual life insurance company, the policyholders are the owners. So you are getting all the dividends that are declared. Okay. And also for people to understand that, whole life insurance has gotten a bad rap, but it's really what the wealthy use. That's what they use to store their cash. And a policy that is set up correctly can help you put away a lot more cash than what you're paying in the premiums. Okay.
Why do you think that is? Because whenever I talk to people about whole life insurance, they're like, ooh, whole life.
Yeah.
That's so expensive.
Yes.
How did that happen?
Here's here's what I like to try to help people understand. So term life insurance, as we understand it today, where you are paying a smaller premium and it's a fixed amount for 10, 20, or 30 years, that is a product that just came about just in the 1970s. So again, for centuries before that, it didn't exist. Term life insurance prior to that was just an annual renewable term. When people had term life insurance, they understood that every year it was going to go up a little bit because of the nature of insurance, right? As you get older, your likelihood and probability, you're closer to the likelihood of dying, right? Your health is probably not as good as it was in your younger years. And those are the kind of things that factor into the cost of insurance. So what they did was in the 70s, and it's the company who's today known as Primerica, but it was literally just a marketing, it was like their tagline, buy term and invest the rest. And now today that is considered financial advice, but it was really just a tagline for their company. They designed this new product where you didn't have this annually increasing amount of term insurance. You just had a fixed amount for a 10, 20, or 30-year term. And that's why it's called term, because it's only available to you for that period of time. Now you can get it after that, but you would see that your premiums would skyrocket after that, because in those first 30 years when most people get it, so pretty much before age 50, your likelihood of dying at that age is so low. And that's why the cost is so low, because the risk to the insurance company is so low. But whole life insurance covers just that, your whole life. So think of it as term insurance, but the term is for the duration of your life. So if you buy it when you're 25 and you live to be 90, that's a long term, right? So that's why it costs more, because it is a fixed amount, or it can be. We can set it up to be very flexible, but in most cases, it's a fixed amount for that period of time, and it has considered the fact that you're going to age, and you are going to pass away, and they are going to have to pay a death benefit. Most term policies do not pay out a death benefit because people don't end up dying in that time. Okay.
Right. So it's almost like, it's not exactly like this, but it's almost like the difference between renting and owning.
It is.
Where one, you don't own it. With the term life, it's just for a certain term and you don't get that money back.
It's exactly that.
With the whole life, it's like you're paying into this policy, but you still have access to that money. It belongs to you and it will be with you for the rest of your life.
Correct. It's like you're building equity, right? It's just like you said, it's just like when you own your home, hopefully you build equity, and then you have access to that. Whereas with the whole life, it's just you have access to liquid assets to use for things like investing in real estate.
Okay. I love it. Keep going.
Yeah. So there, I literally have a list of 25, and it's a download that people are welcome. I can share it to them, but this is just a few of the benefits. So we kind of touched on some of them, right? The control, the easy access. But what I really like to highlight to people is the fact that you don't have any ongoing fees. Okay. So a lot of people have, like an advisor or someone who's managing their money, and they're charging a fee for that. It might be 1% of your assets under management. It might be more, but even in addition to their fee, there's all the transaction fees and the administrative fees. And a 401k plan, those have several layers of fees. And any type of brokerage account, anytime you do a transaction, there's a fee, right? So with whole life insurance, you don't have any ongoing fees. And two of the greatest wealth destroyers that people are so unaware of are fees and taxes. And so whole life really just helps you with that. I was recently talking to a tax attorney, and she called whole life insurance the last legal domestic tax shelter because it's literally where you can stuff your money out of the purview of the government legally, obviously, especially again, if the policy is set up correctly. And oftentimes people have to end up getting multiple policies because there are limits to how we can structure it. We can't just put everything into one policy. So most people end up getting multiple policies throughout their lifetime so that they can continue to put cash away. But yeah, you don't have the risk of the stock market volatility, or, if some world leader sends out a tweet and starts a war, has no impact on your money.
Right.
Okay.
Right.
But what I wanted to highlight here is that with whole life insurance, you really can show how you can really use it for money coming in. So for your investments, Annie, people who have already invested in a property and now they're starting to get those monthly returns, this is a place where you can stuff that money. Go put that money in there so it can grow. Because not only, again, is it going to grow from the guaranteed rate of return, but if there are dividends declared, which I have to say, if dividends are not guaranteed, just like Apple can't guarantee that they're going to declare a dividend each year. But the companies that I use have declared dividends every year for more than 100 years. So that's why I just kind of say that. But all that money is going to grow on top of the money that's already there. So just put more of that cash in. If you're looking to make your next investment with Goodegg, then that's where you have a pool of money in your cash value account that you can leverage. And it's different than any other account, right? When you want to leverage the money from your account, you're not withdrawing the money. If you have a cash value account, you can actually borrow against that money. So it's just like collateral. So instead of withdrawing that money, you're actually just borrowing against that asset. So this is just a quick little example. If you have your money in a cash value account and you've got a property available to you, what we can do here, and in this example, I was showing if someone sets up a business. So if you have your own real estate investment company, you would borrow the money from your cash value. You would borrow $50,000 against it. But that cash value, the value of your cash value still stays at 100,000. Okay. So that 100,000 is still continuing to grow and compound over time. And you would then invest that money to acquire the property. Then, the rental income or the investment income will start to flow that will go back to your company. And so you get that every month, and then you get the lump sum, at the end of the 60 months. And if you choose, or not if, but when you choose, you can put that money back into your policy. And you can do that at any schedule that you choose. So the insurance company, they're not going to lend you money for free. There is definitely an interest rate. However, they're not going to tell you when you have to pay it back, how much has to be paid back, because it's against the collateral on your policy. They understand that, worst case scenario, they have to wait for you to pass away, and they would just deduct that amount from your death benefit. So they're not going to ask you, there's no forms to fill out. They're not going to ask you why you're using the funds. There's no credit application to fill out. There's nothing like that because it's your money. And so you can get access to it to use it for whatever you want. So in this scenario, this person, they could just pay it back. I at least like to advise my clients to at least just pay back the interest each year. But again, after that, you can just pay it back however you feel comfortable.
Okay. So what you're saying is if you had a whole life policy and then you were to borrow against that to invest in investment property, your money would essentially be working for you in not just one place, but two places at the same time.
Yes.
So it's almost like you're double dipping.
It is.
Like,
it is. And we call whole life an and asset, and asset, not an or asset. So you don't have to pick, okay, this dollar can only go here. It can only go to, this 401k plan, or it can only go to this. No, if that money is working in your whole life, it can also work for you in a real estate investment property or something else.
That it goes against everything that we've ever been taught about money. You have $1, you have to choose, right? That's what
I know.
I tell people you have to choose, but this is it's just goes against everything.
Yes.
And it's no wonder that the wealthy have been using this
Yes,
for generations. I
for
mean,
generations. Yes.
I love that. Anytime I can take, it's like a Robin Hood model, right? Like anytime you can take
Yeah.
a strategy from the wealthy and give it to the people, the
Yes.
better.
Exactly. So that's why I work to get out there to just help people understand that what you know about whole life insurance is probably not accurate and is probably not complete. And even if you have a financial advisor who's been telling you about insurance, they may not be an
Hmm.
insurance specialist. So even they might be misinforming you. So you
Right.
want to make sure that you work with someone who is a licensed insurance professional who's familiar with these strategies. You may have heard the term infinite banking. Um, but that's what this is. This is
Hmm.
really leveraging your own money to finance and invest in your life,
Yep.
essentially. Disconnecting
Absolutely.
yourself from the dependency on Wall Street so that you can really do what you need to do when you want to do it with your
Hmm.
own money, or at least leveraging your own money.
Yes.
Yeah.
And that's really the key message I want people to take away from this conversation is I know that in just however long this video is, you're not going to grasp all of the
Right.
principles that Lesley is talking about. That's why she's an expert. Is she spent a lot of time really understanding this. But I know that a lot of you who are watching this are probably like, "Oh my gosh, my mind is blown,"
Yeah.
and it goes against everything I've been taught.
Yeah.
And but the key thing I want everybody to understand is that this is an incredible vehicle and that it's worth setting aside what you've been taught about it to really dig in and to learn more, to do your own due diligence and
Yes.
talk to Lesley or someone like Lesley to learn more about how you can make this strategy work for you.
Absolutely. Absolutely. And I do have a virtual practice. I'm based in Florida, but if you are listening to this and you live in another state, by all means reach out to me. I might already be licensed in your state to help you. So uh, as I said, make sure you work with a licensed professional. I know there's a lot of websites out there that just say, submit this information, get a quote, and you can get insurance, but it's not going to necessarily be structured in a way that's going to, help you build
Right.
wealth. And that's
Right.
really my ultimate goal.
And
Mhm.
especially because this is going to be something you're going to carry with you for the rest of your life, you
Yes,
want to be sure to do it right.
correct.
So, Lesley, if people wanted to talk to you to learn more and work with you, how can they get in touch with you?
Yes, they can just simply go to rebelrockwealth.com. If you go to rebelrockwealth.com/schedule, you can just schedule a discovery call. It's totally complimentary. We just take 30 minutes. I can hear a little bit about what your current situation is and what you're looking to do. And if you're looking to, put some money together to finance another great deal with Goodegg Investments, I'm more than happy to help you, figure that out.
Perfect. And last bonus question is where does the name Rebel Rock come from?
Well, the rebel part of the name is because, so many, I guess, financial professionals, just talk about investing in the stock market and just the things that you see through commercials. I mean, there's whole cable channels dedicated to teaching you or telling you about the news in the stock market. But
Mm-hmm.
I just think that there's so many other ways to grow your money that people don't know about, or they've
Mm-hmm.
heard about it, but because they don't hear enough about it, they're unsure and unconfident. And so the
Mm-hmm.
rebel part is saying, hey, my whole specialty, or the only thing I focus on in my practice, is alternative assets. So it's a little rebellious because I'm not
Mm-hmm.
licensed. I'm not, licensed to sell securities. I have no interest in selling securities. When I'm interested in investments that require that, I reach out to folks like Annie because they have access to those types of investments. I really just like to help to show people to, take control of their own money instead of handing it to someone else to control and those kinds of things. So it's a little rebellious in how I work my
Mm-hmm.
practice. And the rock is really just about having a solid foundation. And I believe that whole life insurance is that solid foundation, and you
Mm.
build your investments and everything else on top of
Nice. And it's also like rock and roll, like let's get
it.
rocking, like let's have some fun, right?
Exactly.
So I love
Exactly.
it. Lesley, thank you so much for diving into this with us. And I'm
You're welcome.
sure that people will have lots of questions for you. So we'll be sure to send them your way.
I'd be glad to help. Thank you.
Okay, so is your mind blown or what? Right? It's like all these things we've been taught all our lives about money and about insurance. Turns out that's not actually how it works. And so, what Lesley talks about with using whole life insurance in conjunction with investing can really be a way to rocket your wealth. And I especially love how Lesley laid it out that whole life insurance should really be a vehicle for savings versus a vehicle for investment. There's sort of two different buckets. So hopefully in this video, you have started to grasp a little bit more about what whole life insurance is all about and how you can use it in your life to help you and your family to grow your wealth. And of course, if you have additional questions, don't hesitate to reach out to us at info@goodegginvestments.com or to reach out directly to Lesley. All right, thank you so much for watching. And as we always say, we hope you have a sunny side up day.